So if you're holding European euros and euro-denominated debt, and you're getting a negative interest rate or thereabouts, and the same is true in Japan, and you're not making up with inflation, none of those are good. And like in the 30s, they all depreciated, they all went down in relationship to goods and services and other asset prices. So what you see is all the currencies along those lines are sort of tied to each other, and they're bad storeholds of wealth, and that's why you see moves to other assets. It pays to borrow, or if not borrow, but put your money into assets that maintain buying power. So you see it happen in all the different ways. So look at whether what you're holding in the form of that cash denominated, and that'll be a debt instrument. That's how you hold a currency in order to have a storehold of wealth. Look at its real returns. The Fed understands, and central banks know, that when inflation is undesirably high and the economy is relatively strong, you put on the brakes, and that when the reverse is the case, you put on the gas. And they don't understand, I think, monetary inflation enough. What has happened is that because they put on the gas so much, have allowed interest rates to be so low, as I say, in many cases, negative interest rates, and they've made liquidity so abundant that not only didn't you have to pay interest on your debt, but you didn't have to pay principal on your debt, because they would have interest-only loans, and they would have low covenants, like it's easy to not meet your debt requirement. Companies borrow, individuals borrow, interest-only loans, and when there's no interest rate, basically mean the stuff is free. You can buy houses, you can buy all sorts of things on that basis. And the world has adapted to that, and they did that at a very low real interest rate, a very low interest rate relative to inflation. And then they printed a lot more of that money and so on. And so inflation is going up. So mechanistically, what that means is now we have a lot more debt, and we have an economy and a markets, financial markets, that the pricing is structured based on those very low interest rates and that amount of liquidity. So when you go through the calculations, when I go through the calculations, and I figure a high enough level of interest rate to provide a decent real return is, for a holder of the debt, is much too high of an interest rate for the markets and the economy. But you're going to have an inflation rate that's above the interest rates, and that's not going to be desirable. So investors want to sell that. And you could see it as interest rates rise. You can see its effects on markets. You could see the effects on the capital markets. So you see the stock market going down while the bond market is going down. And that means most everything that people own practically are going down practically, because most people are in stocks and bonds, that kind of thing. The Fed's trade-off is going to be very difficult. Right now, they have a very restrictive monetary policy plan. I judge that by the supply and the demand for credit. So the federal government is going to run large deficits. So that means they will have to sell debt. They'll sell treasury bills and bonds. The Federal Reserve is planning to sell $1.1 trillion of debt also. Private investors are inclined, pension funds and so on, they're losing money while there's inflation, so they're losing buying power. They're selling. And there's a selling imbalance. And that selling imbalance means, because it has to balance with the buyers, that means a contraction in private credit, which means a recession.